Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Paris Rapeseed. Since the triple top at the end of last year and the start of this year, we saw prices generally head lower until mid-March. On the way down, key levels were the long moving average, currently at 493.25, gap left over by changeover, originally at 490 even to 509.75, but ending up being partially filled in before in early March, and falling and the fall which ended with a hammer pattern mid-March, with prices subsequently rising and forming a V bottom pattern. Now, I thought there was seemingly another more interesting pattern developing here. You see the whole flat run in during February, the drop and rise in March made the whole action, as I mentioned 6 weeks ago, look like a bullish diving board pattern. Unfortunately, the market had other ideas as prices rose up to meet the long moving average and was stopped dead there 4 weeks ago, promptly falling away again in a series of counteracting bullish and significantly bearish patterns. We saw prices capped by the declining green short medium moving average, currently that's above, currently at 479.75, and roughly supported by the 50% Fibonacci line of the May 23 to January 25 move below at 467.25 and the 2013 high of 464.25. All this allowed me 3 weeks ago to draw a prospective late February to early April bearish Andrews pitchfork. Said at the time, I'm not wedded to this pattern and I'm quite prepared to finesse this to a shallower bearish shift pitchfork or retire it completely, but for now it will do, showing the most recent bearish angle of attack, end of quote. Well, eventually this bearish Andrews pitchfork would not do, and I have this week finessed it into a shallower dark blue bearish shift pitchfork with the same late February, early April move, which does seem better at showing the bearish angle of attack. Prices are testing the middle time, currently at 461.25. However, please note just below we have the bright red, recently reassigned, so it's not necessarily that strong, but recently reassigned February 24 to date uptrend, currently at 456.25. This appears to be the only support of note below, despite some congestion in the region back in August last year, until we reached a wide congestion zone between 449 even down to 438 even, containing the highs of April, March and June 2013, plus the very important 50% absolute Fibonacci line at 445.5. Winnipeg Canola. The market halted its decline in March by a combination of the lows at 467 even, 571.80 and 575, plus the neckline extension, currently at 554.70, of the April to June 23 reverse head and shoulders continuation pattern. Now I'd also possibly throw in the combination of September 24 low and pipe bottom at 553.5 and the October 2020 high at 552.80. We didn't reach all of these, but the proximity and market actions on approach to these suggested a swift and immediate pullback up for prices. However, the recovery higher, though dramatic, initially had some issues. For instance, there was no weekly key reversal up or even the lesser outside week opportunity here as seen in other markets. The reasoning I gave back then, and which still seems sound, was because of the previously mentioned 50% absolute Fibonacci line that sat overhead back then at 606.90, and this seemed to put off initial attempts higher. However, as I said 5 weeks ago, and I quote, the action over the last 3 weeks, so that's now possibly 8 weeks, the action over the last 3 weeks does suggest the construction, or at least hints at the possible construction of ascending wedge pattern, possibly even an ascending triangle. We shall see on that, but it is worth paying attention to if we do go down this route, end of quote. Well, prices shot up through the 50% absolute Fibonacci line 5 weeks ago, hesitated for a bit around the moving average congestion area, which was then around the 2021 low at 629.60, before moving higher moving higher further still. Now, to explain this move upwards, I spoke 4 weeks ago of the possibility here for a start of February to date bullish diving board pattern. However, I did add that the, and I quote, pattern here is very, very crude, with the run-in during February not looking very straightforward in my eyes. The plunge in early March looks good, but the recovery higher in late March looks indecisive at the start, though we've since become more determined, end of quote. However, prices have continued their journey higher, making significant moves up and over the February high, despite a ropey start. This is a better bullish diving board pattern seen here than seen anywhere else in the oil seeds and veg oils that I cover. It has nevertheless still run to resistance at the February high at 682.20 and the early July 2024 high at 685.30, but prices have motored on through higher. To give you some context to this move higher, here is the data regarding diving board patterns. Nearly 9 out of 10 times the price rises as far as the bottom of the board. Now, this is a good example of a diving board pattern, but I would regard this it's not a good example of a diving board pattern, but I would regard that as being about the 2021 low at 629.60, which we have seen. A quarter of them then rise up within the diving board pattern itself, so between about 629.60 to the June 2021 low at 655.90, which we have also seen. Just over 6 out of 10 times prices rise up over the diving board, that is over 655.90, which we indeed have also seen. In truth, we're running into some overhead resistances now, but as I said last week, and I quote, to add to all this, we are very close to setting up a possible weekly key reversal this week. It all depends, to start with, on making a higher high than last week, so over 687.10. This is the level to watch this week, that's speaking last week, and that's the end of the quote. Well, prices did indeed reach and exceed that 687.10 level and did form a weekly key reversal up last week. However, we have not followed on higher this week, not just yet. This is due to the next overhead resistance, which is the 50% Fibonacci line, the July 23 to September 24 move at 700.5, and the July 2008 high above that at 710.80. Above this, we have some generated congestion roughly between 723.70 to 735.20, plus a recent ascending wedge lower trendline extension, currently 610.80 or so. This whole action over mid-March today has also given us a small, acute bull channel, currently 675 even to 719.10. This one is not ideal and it may need some finessing, but that is what is the core at driving prices higher right now, that bull channel action. Bursa Malaysia crude palm oil. Prices have over the last 4 weeks broken down through some major structural supports. To start with, there is the neckline currently at 44.99 of the September to November 23 reverse head and shoulders pattern, which I've highlighted repeatedly, and which, though supporting the market during March, 3 weeks ago saw prices gap lower below it. Next, and this one I have also commented on many times previously, is the neckline currently also at 44.99 of the September 2015 to November 2017 head and shoulders top. I have not been sure about this one in the past, but as it is an old one, a super old one, that had been way below the current market back in the day, but similarly to the earlier neckline, had at the start of this year significantly supported the market, so worth noting, though it also failed 3 weeks ago. The third pattern here is the now flatlining long moving average, currently at 43.96. That stopped the market's fall dead in mid-January and late March, but which failed 3 weeks ago. There are also other newer, in some cases closer to the market features that have helped hold up the market, but which have now given way. To start with, I'd look to the wide congestion area now overhead between 44.08 to 45.59. This is now weighing down on the market. Next, 5 weeks ago, I drew a mid-February to early March pink, mildly bearish shift pitch hook. A more acute bearish Andrews pitch hook for this move did not work, so it was very much this pattern or retiring it completely, which I'm quite prepared to do even now. I will do that in a second anyway. During March and the start of April, this pattern had shown the bearish angle of attack, but 3 weeks ago, prices penetrated the pink lower time, currently at 42.52, initially down to the significant combination of the 38.2% Fibonacci line with the May 20 to March 23 move and the 50% Fibonacci line of May 23 to December 24 move, both at 42.74, and that is the Fibonacci line just below that at 42.39. I said 2 weeks ago on this, and I quote, "For the moment, I'd still keep an eye on the pink bearish shift pitch hook, but it seems that some significant bearish pressure is meeting some quite substantial bullish supports. something has got to give, and for now it's looking like the downside might. If it does, then apart from the July 23 high at 41.89, we might not have anything of note below until the congestion starting at 40.26, end of quote. And I said caution, and that's the end of the quote. Well, 2 weeks ago we gapped lower and dropped down through the 40.26 zone. However, this was an elastic move lower with a swift move back up early last week, trying to fill in the gap left behind, but failing to do so, making another smaller gap lower over this past weekend, and down to the one support that so far has not given way. The previously highlighted dark blue neckline extension, currently at 38.89 of the small late May to April 24 reverse head and shoulders bottom. As I said last week, and I quote, "This is one to watch on the downside, as it is core of a large April to September 24 congestion zone, stretching from roughly 3750 to 4100, end of quote. These actions have brought to my mind last week another new pattern that may be just about completing, but which can even now still be derailed. It is to look at the whole move down from the high back in early December 24 to date as a really big halfway hesitation pattern. To give an idea of the potential on the downside, we have a possible target X down at 3750, right on the far end of the congestion we sit within right now."
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.